What do the Fed's latest discount rate minutes really tell us? And how can they help you anticipate moves in rates, stocks, and credit? Most investors watch the federal funds rate, but the discount rate and the minutes around it offer a quieter read on how the system's plumbing feels. These minutes capture how each regional reserve bank judged inflation, growth, and credit when advising on the primary credit rate the interest banks pay to borrow short-term at the Fed's discount window. Think of the discount rate as a backstop. It is not the headline policy lever, yet it shapes how banks plan liquidity and handle stress. When market funding gets tight, the comfort level with using the window can steady money markets, so language around the rate and around discount window usage can hint at how resilient bank funding is and how officials view financial stability risks. The minutes distill what the 12 reserve banks recommended and why. You'll hear how they read inflation, whether persistence is fading or sticking, alongside signals from wages and employment. You'll hear how loan demand and underwriting are shifting, what is happening with deposits and wholesale funding, and whether any regional soft spots are emerging in consumer spending, housing, or business activity. You may also catch references to international developments that could spill into dollar liquidity. For investors, the value is in the nuance. If many reserve banks favored holding the primary credit rate steady while emphasizing disinflation progress, that supports a view of easing pressure ahead. If several highlighted tight labor markets, firm wages, or renewed funding costs, that leans hawkish. Mentions of increased discount window usage can mean stress is being managed, but also that some banks are tapping backstops more often, which matters for risk sentiment. Use a simple reading plan. Compare the economic tone to recent FOMC statements to see if the center of gravity is shifting. Track whether credit demand is cooling or re-accelerating and whether deposits are stable. Note any regional divergences that could foreshadow sector winners and laggards. Then connect the dots to market pricing, front-end yields, bank equities, credit spreads, and liquidity-sensitive assets like broad ETFs and parts of crypto that respond to dollar conditions. Bottom line, these minutes are not a forecast, but they are a map of how policymakers weigh risks. Read them to gauge resilience in bank funding and the direction of financial conditions before the next big policy meeting. Read the full article at finlitica.com.